What's up, everybody? It's GoldWise here, and let's talk money, investing, and building wealth. Welcome to our channel. Today, we're diving into the world of financial markets. It might seem intimidating at first, with all these different players and jargon, but trust me, it's not as complicated as you think. We'll break down the key participants and explain their roles in an easy-to-understand way, using real-world examples and relatable analogies, so you can grasp the concepts without breaking a sweat. Alright, let's kick things off with issuers. Now imagine a company like Tesla. They've got this awesome new electric car they want to build, but it's going to take a ton of cash to get it off the ground. I mean, developing cutting-edge technology doesn't come cheap, right? So how do they get that cash? That's where issuers come in. Issuers are like companies or even governments that need to raise funds for various reasons, like launching a new product, building factories, or even funding infrastructure projects. Think of it like this: they've got big dreams and even bigger plans, but they need the financial firepower to make it happen. So how do issuers actually raise this money? Well, they do it by issuing securities, which are basically financial instruments that represent an ownership stake in the company or a debt obligation. The two most common types of securities are stocks and bonds. Let's start with stocks. When a company issues stock, it's essentially selling off little pieces of ownership in the company in exchange for cash. So, when you buy a share of Tesla stock, you're becoming a part owner of Tesla. Pretty cool, right? Now on the other hand, we've got bonds. Bonds are a bit different. When a company issues a bond, they're essentially borrowing money from investors and promising to pay back the principal amount plus interest over a set period of time. Think of it like giving the company a loan and receiving interest payments for your generosity. Now these companies don't just go around, hat in hand, asking for money. They work with investment banks, kind of like financial advisors for big companies, to help them structure the offering, set the price, and find investors. It's a whole process, kind of like a carefully choreographed dance in the financial world. So to sum it up, issuers are the entities that need money, and they get it by issuing securities like stocks and bonds. These securities are then bought by investors who are looking to grow their wealth and be a part of the action. Now, let's talk about investors. These are the people, or institutions, who buy those stocks and bonds that issuers offer. They're the ones putting their hard-earned money to work in the financial markets, hoping to see it grow over time. Investors come in all shapes and sizes. You've got individual investors like you and me who are just trying to save for retirement, buy a house, or maybe even travel the world. Then you've got institutional investors like pension funds, mutual funds, and hedge funds who manage massive pools of money on behalf of their clients. What motivates investors? Well, it all boils down to one thing: returns. Investors are looking to make money, plain and simple. They buy assets they believe will increase in value over time, whether it's stocks, bonds, real estate, or even cryptocurrencies. Of course, investing always involves some level of risk. The higher the potential return, the higher the risk. That's why it's crucial for investors to do their research, diversify their portfolios, and invest for the long haul. Think of it like this: investing is like planting a tree. You carefully choose a healthy sapling. That's your investment. Plant it in fertile soil, that's your chosen market, and nurture it with patience and discipline. That's your investment strategy. Over time, with the right conditions, your tree will grow strong and bear fruit. That's your return on investment. Now, there are different types of investors with different risk tolerances and investment goals. Some investors are comfortable taking on more risk for the potential of higher returns, while others prefer a more conservative approach. For example, a young investor with a longer time horizon might be more inclined to invest in growth stocks, companies that are expected to grow at an above-average rate, even if they come with higher volatility. On the other hand, an older investor approaching retirement might prioritize preserving capital and generating income, so they might lean towards bonds or dividend-paying stocks. No matter what your investment style or goals, the key is to have a plan, stay informed, and be patient. Remember, investing is a marathon, not a sprint. Now, let's move on to a couple of other key players in the financial markets: speculators and market makers. These folks are like the adrenaline junkies of the financial world. They thrive on risk and volatility. First up, we've got speculators. These are traders who try to predict short-term price movements in assets like stocks, bonds, or currencies, hoping to make a quick profit. They're essentially betting on whether the price of an asset will go up or down, and they often use leverage to amplify their potential gains and losses. Think of speculators like day traders. They're constantly buying and selling, trying to time the market perfectly. It's a high-risk, high-reward game, and it's definitely not for the faint of heart. They're like surfers riding the waves of the market, trying to stay ahead of the curve and capitalize on short-term price swings. While some people might view speculators as gamblers, they actually play an important role in the financial markets. Their trading activity helps to create liquidity, which makes it easier for investors to buy and sell assets at fair prices. Now, let's move on to market makers. These guys are like the referees of the financial markets. They ensure there's always a buyer and a seller for every asset, even during times of high volatility. They do this by constantly quoting bid and ask prices for securities, essentially acting as intermediaries between buyers and sellers. Imagine a busy marketplace with vendors selling all sorts of goods. Market makers are like those vendors who always have a stock of goods ready to sell, ensuring that buyers can always find what they're looking for. They provide liquidity to the market, which means that investors can easily buy and sell assets without having to wait for a matching order from another investor. Market makers make money by profiting from the spread between the bid and ask prices. It's a small margin, but it adds up over a large number of trades. They take on some risk by holding inventory of securities, but they also provide a valuable service by ensuring a smooth and orderly market. So, while speculators and market makers may seem like risky business, they actually play crucial roles in the financial ecosystem. They provide liquidity, facilitate trading, and keep the markets moving. Alright, now that we've met some of the key players, let's talk about where all the action happens. The stock exchange. This is basically the marketplace where buyers and sellers come together to trade securities like stocks and bonds. Think of a stock exchange like a giant auction house, but instead of rare paintings and vintage cars, they're trading shares of companies and other financial instruments. It's a bustling hub of activity, with orders flying in from all over the world and prices fluctuating constantly based on supply and demand. Now, there are stock exchanges all over the world, each with its own set of rules, regulations, and listing requirements. Some of the most well-known stock exchanges include the New York Stock Exchange, the Nasdaq stock market, and the London Stock Exchange. These exchanges act as intermediaries, connecting buyers and sellers and ensuring that trades are executed fairly and transparently. They provide a platform for companies to raise capital by issuing stocks and bonds, and they offer investors a way to participate in the growth of those companies. In the past, stock exchanges were physical locations with trading floors full of brokers shouting orders and making hand signals. Remember that iconic image of the NYSE trading floor with all those people in colorful jackets? Today, most trading is done electronically, with sophisticated computer systems matching buyers and sellers in a matter of milliseconds. It's much faster and more efficient than the old open outcry system, but it also means that the market can move incredibly quickly, and small investors might find it hard to keep up with the big institutional players. Each stock exchange has its own listing requirements that companies must meet to have their securities traded on that exchange. These requirements typically include factors like market capitalization, financial performance, and corporate governance practices. Think of it like a club with exclusive membership. Only the companies that meet the criteria get to be listed and have their shares traded on the exchange. So, the stock exchange plays a vital role in the financial markets by providing a regulated and organized platform for buying and selling securities. It's the central hub where companies can raise capital and investors can grow their wealth. Now, you might be wondering, how do I actually buy or sell stocks and bonds? Well, that's where brokers come in. Brokers act as intermediaries between investors and the stock exchanges, facilitating trades and providing access to the markets. Think of a broker like a real estate agent for your investments. Just like a real estate agent helps you buy or sell a house, a broker helps you buy or sell stocks, bonds, and other financial instruments. They handle all the paperwork, execute your trades, and provide you with access to research and other resources. There are different types of brokers, each catering to different types of investors. You've got full-service brokers, who offer personalized advice, wealth management services, and access to a wide range of investment products. They're like your personal financial advisors, guiding you through every step of the investment process. Then, You've got discount brokers, who offer a more streamlined and affordable trading experience. They provide a platform for executing trades, but typically don't offer the same level of personalized advice or investment research as full-service brokers. Think of them like online travel agencies. They give you the tools to book your own flights and hotels, but you're on your own when it comes to planning your itinerary. In today's digital age, online brokers have become increasingly popular, offering investors a convenient and cost-effective way to manage their investments. With online brokers, you can buy and sell securities from the comfort of your own home, 24/7, with just a few clicks of a mouse. When choosing a broker, it's important to consider factors like fees, trading platform, research and educational resources, and customer support. Do your research, compare different options, and choose a broker that aligns with your investment goals and risk tolerance. Remember, not all brokers are created equal. Some brokers might specialize in specific types of investments, such as options or futures, while others might cater to a more passive investing approach, offering robo-advisory services or pre-built portfolios. Just like you wouldn't hire a plumber to fix your electrical wiring, you wouldn't want to choose a broker that doesn't align with your specific investment needs. Last but not least, let's talk about the regulators. These are the watchdogs of the financial markets, ensuring that everyone plays by the rules and that investors are protected from fraud and manipulation. They're like the referees of a sporting event, making sure the game is played fairly and that no one is cheating. In the United States, the main regulatory body for the financial markets is the Securities and Exchange Commission, or SEC. They have a big job to protect investors, maintain fair and orderly markets, and facilitate capital formation. Think of the SEC as the financial police, cracking down on insider trading, accounting fraud, and other shady practices that could harm investors. They're there to make sure the markets are a level playing field for everyone. The SEC requires companies to disclose important financial information to the public so investors can make informed decisions. They also regulate brokers and investment advisors to ensure they're acting in the best interests of their clients. In addition to the SEC, there are other regulatory bodies that oversee specific aspects of the financial markets, such as the Commodity Futures Trading Commission, or CFTC, which regulates futures and options markets, and the Financial Industry Regulatory Authority, or FINRA, which oversees brokerage firms and their employees. These regulators play a crucial role in maintaining the integrity and stability of the financial markets. They help to ensure that investors can trust the system and that their money is safe. Without regulators, the financial markets would be like a wild west, with fraudsters and manipulators running rampant. While some people might view regulations as burdensome or unnecessary, they actually play a vital role in protecting investors and maintaining a fair and transparent market. Just like we have traffic laws to prevent accidents and ensure the smooth flow of traffic, we have financial regulations to prevent market crashes and protect investors. So the next time you hear about regulators cracking down on some Wall Street shenanigans, remember that they're doing it to protect you, the investor, and to ensure that the financial markets remain a safe and reliable place to grow your wealth. And there you have it. A quick look at the key players in the financial market, from the companies issuing stocks and bonds to the investors buying them, the speculators making risky bets, the exchanges where it all goes down, the brokers facilitating trades, and the regulators keeping everything in check. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insightful content. We've got a ton of great videos coming up on everything from personal finance to real estate investing to building a successful business. Thanks for watching, and we'll see you in the next video.